Welcome to The Explainer. Today, we're putting on our detective hats because we've got a real mystery on our hands, a sudden, sharp fall in the market. We're going to look at all the clues, piece them together, and figure out exactly what went down.
Okay, so let's set the scene. Just look at this, a sea of red. Across the board, everything was flashing red, from the big Nifty 50 index to the mid-caps and small caps. And this wasn't just a tiny dip, you know? The major indices dropped over 1%. That tells you right away that the negative feeling was pretty much everywhere.
So that's the big question, isn't it? What caused all this? Was it one single thing? A bunch of things happening at once? Well, to get to the bottom of it, we've got to follow the money and hunt for clues in the data.
First things first, let's take a closer look at the damage from today's trading.
And here's the headline number that got everyone talking. The Nifty 50, the main benchmark, fell by a whopping 318 points. That's a 1.3% drop in just one day. A move like that definitely makes you sit up and take notice. Something big was going on.
Now, like any good investigation, you gotta follow the trail of evidence. So let's see which part of the market was really feeling the pain.
You know, every market move has its ringleaders, whether things are going up or down. So our next job is to figure out who the main culprits were, the ones dragging the whole index down.
And boom, our first major clue points us straight to one sector, banking. The Nifty Bank index got hammered, falling 658 points. Seriously, when the banks are that weak, it tends to send a pretty powerful ripple effect across the entire market.
And if we zoom in even closer, right into the banking sector, we find two prime suspects at the heart of it all: ICICI Bank and HDFC Bank. Both of these heavyweights saw some really sharp, continuous selling all day long.
In this right here, this is the proof. ICICI Bank and HDFC Bank weren't just falling. They were the top two draggers on the entire Nifty. I mean, get this. Together, just these two stocks were responsible for over 77 points of the Nifty's 318-point drop. That's almost a quarter of the whole fall just from two stocks.
Okay, so we've identified our culprits, but any good detective will tell you you need a motive. Why the sudden sell-off in these huge banks? What was the trigger? And here it is, the smoking gun, a direct link between the market's bad mood and a very specific economic event, the release of new GDP numbers. This is the why we've been searching for. So here's what happened. The government revised its forecast for nominal GDP, which is basically economic output before you adjust for inflation. And for this year, FY24, they cut the growth forecast from 12% all the way down to 11%. Now, 1% might not sound like a huge deal, but in the world of economics, it's a big signal that overall economic activity might be slowing down. And that directly hits the outlook for company profits, especially for sectors like banking that really rely on strong economic growth.
Okay, we've pretty much solved the central mystery. But a good detective always checks the wider context, right? Just to make sure all the pieces of the puzzle fit.
And check this out. Looking at the trend for the whole week gives us even more evidence. The sectors that did well are the defensive ones, you know, like pharma and healthcare. And the ones that lost, they're the sectors that depend on growth, like realty and IT. This is a classic risk-off mood, where investors are basically running from risk and towards safety. And that lines up perfectly with our whole GDP surprise theory.
We also saw this huge tug-of-war between different types of investors. Foreign institutions, the FIIs, were selling big time. They pulled over 7,500 crore out of the market. But at the same time, domestic institutions, the DIIs, were buying. This kind of push and pull is often a sign of major uncertainty, usually when some new information, like those GDP numbers, hits the street.
And it wasn't just about stocks, you know? Other assets were making moves too. The big one to notice was Brent crude oil, which jumped over 2%. And that just adds another layer to the story, because higher oil prices can put even more pressure on the economy, making those concerns from the GDP data even worse.
So, the investigation is complete. We've gathered all the evidence, we've identified the culprits, and we've found the motive. Let's lay out the whole story one last time.
So here's the chain reaction step by step. It all kicked off with that one piece of economic data, the GDP revision. That news slammed the banking sector, and because giants like HDFC and ICICI have such a massive weight in the index, their fall was enough to pull the whole market down with them. It's a classic case of a big-picture event creating a small reaction that just snowballs.
And all of that leaves us with one final big question. We've solved the mystery of today's fall, but what about tomorrow? Was this just a quick, knee-jerk reaction to a single report? Or is this the first sign of a much bigger change in how investors are feeling about the market's future? For now, that case remains open.